Welcome to the research desk. Imagine finding out that the entire multi-trillion-dollar retirement industry, the algorithmic robo-advisors managing your savings, the passive index funds dominating global markets, the default target date accounts holding the bulk of human working wealth, is entirely built upon a single mathematical statistic.
Just one statistic?
One single statistic, calculated from a lone academic paper published back in 1986. And then, imagine finding out that this foundational statistic has been completely systemically misunderstood by the financial professionals wielding it for 4 decades.
I come at this from the seat of an outsider, looking at this structural behemoth. And what strikes me immediately is the sheer scale of the disconnect. My livelihood, anyone's livelihood, participating in modern capitalism, depends on the answers to these exact questions.
Exactly. We are examining the consequences of a monumental puzzle in institutional capital. When you observe a portfolio's performance at the end of a 10-year cycle, what actually drove the final outcome?
Right. Because everywhere I look, the modern financial apparatus feeds me this monolithic narrative. They insist picking individual stocks is a fool's errand. They say trying to time market crashes is statistically impossible.
Which leads to the claim that the only thing requiring any intellectual effort is deciding the broad mix of your assets.
Exactly. And it is utterly incredible to me that this absolute gospel of global finance, the explosive ascendance of Vanguard, the routing of trillions of dollars into automated glide paths, rests entirely on one obscure data point from the mid-1980s. The idea that a single paper could rewrite the entire compensation structure of wealth management requires us to interrogate exactly what that number was supposed to mean.
We really must interrogate it, because the underlying lesson genuinely holds weight, but the 93.6% figure is, without question, the most misquoted, misunderstood, and improperly weaponized statistic in all of personal finance.
So where does this 93.6% actually come from? Who calculated it?
In 1986, researchers Gary Brinson, Randolph Hood, and Gilbert Beebower set out to answer that exact question of what drives returns. But to grasp how a single calculation could be so profoundly misapplied, we have to transport ourselves back to the early 1980s.
Set the scene for me. What did Wall Street look like before this paper?
We have to examine the specific ecosystem of a multi-billion-dollar corporate pension fund in that era. This was long before passive investing dominated the landscape. Wall Street was an ecosystem of massive egos, astronomical management fees, and a shocking absence of empirical evidence.
Meaning they didn't actually know where the returns were coming from?
They had zero empirical evidence regarding where investment returns actually originated. If you sat on the board of one of these pension funds, your mandate revolved around 3 major decisions. The first of these is asset allocation.
Okay, define that mechanically. What exactly is asset allocation?
Think of this process like building a house. You are deciding on the architectural blueprint, you're pouring the foundation, and choosing the primary structural materials. You must decide if you are building a sprawling, single-story structure or a fortified, multi-story complex.
So it's the broad strokes of the plan.
Exactly. In the financial realm, asset allocation is the long-term target mix of your capital. It is the structural framework deciding that, say, exactly 60% of the fund will purchase equities, 30% will purchase fixed income bonds, and 10% will be held in cash equivalents.
The blueprint analogy clarifies the broad strokes, sure. But if asset allocation is merely the structural foundation of the house, we need absolute precision on what the highly compensated managers were actually doing inside that house.
That brings us to the second decision.
Because Wall Street in the 1980s was famously obsessed with the minutia, right? The specific corporate bets, individual bankruptcies, hostile takeovers. If they were not just drawing up a rigid blueprint, what was the technical mechanism they utilized to justify their exorbitant fees?
The technical mechanism was security selection. If the asset allocation is the structural blueprint, security selection is picking the specific furniture, the exact paint colors, the custom cabinetry for the rooms.
So zooming in from the structure to the granular details.
Right. You have already decided you are going to have a living room. That is the asset allocation. But choosing the specific mid-century modern sofa that goes into it is the security selection. In the markets, security selection is the process of picking the specific companies or municipal bonds within those predetermined asset class buckets.
I see. So you decided on 60% equities, and now you have to choose which specific 500 corporate entities make up that 60%.
Precisely. This is where managers attempt to generate alpha.
Alpha. That's a term thrown around constantly. What is the actual definition here?
Think of alpha as the interior designer's brilliant, unique flair. It's the specific design choices that make your specific house appraise for $1 million more than identical houses on the exact same block. Formally, alpha is the excess return of an investment relative to the return of a benchmark index.
So it's the value added purely by human skill above the baseline.
Exactly. And beyond security selection, there is the third critical decision: market timing.
How does that fit into the house analogy?
Imagine you are living in this house, and you attempt to predict when a massive hurricane is going to make landfall. You aggressively rush out, gather all your expensive patio furniture, and lock it in the garage. Then, you try to predict the exact moment the storm passes so you can place it all back outside before the sun shines.
Anticipating disaster and moving assets out of harm's way.
Right. In institutional finance, market timing is the strategy of making tactical, short-term shifts in your portfolio. Moving entirely to cash when the macroeconomic environment looks dangerous, and plunging capital back into equities right before an economic recovery begins.
Okay, but I find it really difficult to accept the premise that these institutional managers were operating entirely in the dark. Active managers in the 1970s and 1980s were securing multi-million-dollar contracts from corporate pension boards to pick that furniture and move it into the garage.
They absolutely were, so it strains credulity to suggest they had no quantitative proof that any of this maneuvering actually generated wealth. If an institution is paying a premium fee, they demand internal performance attribution, don't they? They must have had internal models proving their interior design flair was real, and that their storm predictions were protective.
Well, they certainly had massive performance track records and aggressive marketing materials. But what they entirely lacked was raw, disaggregated data proving which specific decision was moving the needle.
What do you mean by disaggregated data?
Consider a scenario where a pension fund returned 12% in a given year. The active manager would immediately take credit, right? Presenting the board with a narrative that their brilliant stock picks and deft market timing generated the wealth.
Naturally, they want to justify their fee. But the pension board had no mathematical framework to isolate the manager's brilliance from the simple, underlying fact that the broader equity market might have just gone up 10% on its own. Nobody possessed a clean, empirical methodology to separate the blueprint from the furniture selection from the storm preparation.
So they couldn't untangle the variables.
Exactly. That is the fundamental puzzle Gary Brinson, Randolph Hood, and Gilbert Beebower set out to solve. They sought to strip away the Wall Street bravado and look exclusively at the mathematics of performance attribution.
How did they actually do that? You can't just guess at those numbers.
They didn't guess. They secured unprecedented access to an astonishing data set. They obtained the actual granular quarterly performance data of 91 of the largest corporate pension plans in the United States.
91 corporate pensions over what time frame?
They tracked every movement of these funds over a 10-year period from 1974 through 1983.
Okay, a 10-year window measured quarterly across 91 large-scale institutional funds. That yields exactly 3,640 quarterly observations. Compiling 3,640 distinct verified performance observations before the era of automated data scraping is a monumental logistical undertaking.
It was revolutionary for the time.
But examining this strictly as an outsider evaluating a scientific claim, my skepticism immediately centers on the timeline. A single decade in the grand sweep of global financial history is an incredibly narrow slice of time. An entire intellectual foundation cannot rest on an artifact of a weird, highly specific macroeconomic anomaly.
That's a fair critique, but the specific nature of that decade is exactly what makes the data set so robust. The 1974 to 1983 window was not a fluke era where equities simply drifted upward in a straight line.
Because if it was, that would heavily skew any statistical analysis in favor of a static equity allocation.
Precisely. But that specific 10-year span encapsulates two violently different economic regimes. The first half of that period covers the dark, destructive days of the 1970s.
A brutal bear market.
A brutal bear market characterized by crushing stagflation, global oil shocks, and soaring interest rates that fundamentally decimated traditional portfolios. And then, the second half of the window captures the explosive birth of the 1982 to 1983 secular bull run.
So the data observe these massive portfolios navigating deep economic despair, volatile sideways movement, and euphoric expansion.
Yes. But to mathematically isolate the effects of the manager's active decisions across these turbulent regimes, the researchers had to define a strict, unmoving baseline. They engineered a concept known as the policy portfolio.
What is a policy portfolio in practical terms?
Imagine a massive ghost ship sailing across a turbulent ocean entirely on autopilot. This ship is mechanically programmed to hold the exact long-term asset weights that the pension fund originally promised its board, with absolutely zero human intervention.
No tactical shifts? No storm preparation?
None. No specific stock picking, just mechanical adherence to the plan. Formally, a policy portfolio is a hypothetical benchmark portfolio that perfectly tracks passive market indexes at the exact strategic weights mandated by the fund's long-term investment policy.
Establishing a ghost ship requires coordinates, though. Before the active managers begin attempting to time the storms or pick the individual stocks, a committee has to decree that the underlying ghost ship will hold 60% equity and 40% fixed income, rather than an aggressive 80% equity configuration.
That's correct. The baseline itself is an active choice.
So by what mathematical or theoretical mechanism do they arrive at the foundational coordinates for that autopilot?
They arrive at those coordinates by attempting to locate the efficient frontier.
The efficient frontier. We need an analogy for that because it sounds incredibly abstract.
Imagine you are hiking up a treacherous mountain and you want to capture the most spectacular photograph of the valley below. The efficient frontier is the exact edge of the cliff where you secure the best possible, unobstructed view for the exact specific amount of physical danger you are willing to tolerate.
So balancing risk and reward at the absolute physical limit?
Right. If you step back from the edge, you are physically safer, but the view is obscured. If you step forward, the view barely improves, but the mathematical risk of plunging to your death increases exponentially.
And the formal financial definition?
In financial theory, the efficient frontier is the set of optimal portfolios that offer the highest expected return for a defined level of risk or the lowest risk for a given level of expected return.
Okay, so the pension boards utilized historical risk and return data to plot this curve, selecting the precise asset mix that matched their institutional risk tolerance.
Exactly. That optimal mix becomes the ghost ship. So Brinson and his team now possess the ghost ship's quarterly returns, and they possess the actual human-managed pension fund's quarterly returns.
They have the theoretical baseline and the messy reality.
Yes, and this is where the researchers deployed a profound methodological shift. They did not simply rank the 91 funds by who accumulated the most absolute wealth at the end of the decade.
Why not? Isn't absolute wealth the entire point of investing?
It is the point of investing, but it's not the best way to mathematically isolate attribution. Instead of looking at total wealth, they ran a time series variance decomposition.
See, this is the exact juncture where the academic terminology obscures the actual mechanics of the analysis. Time series variance decomposition acts as an intellectual shield designed to make an observer nod blindly rather than question the underlying math.
We must translate the concept of variance in this specific context.
We must, because this appears to be the hinge upon which the entire global misunderstanding of modern finance swings.
So what is variance?
It is the absolute hinge. Think of variance like observing a boat on the open ocean. Over the course of an hour, the physical boat is bouncing violently up and down on the crashing waves.
Just the vertical movement. Exactly. Variance is simply the measurement of how violently
and how far that boat moves up and down relative to its average level position on the horizon. It is a statistical measurement of the spread between numbers in a data set from their average value. It measures volatility, the raw magnitude of the swings over time.
So they aren't looking at the destination.
No. The researchers asked a highly specific mathematical question. When we examine the total variance, the total bouncing up and down of the actual human-managed pension fund over these 40 quarters, how much of that bouncing is directly explained by the mathematical bouncing of the ghost ship, the policy portfolio?
They are entirely ignoring the final destination of the boat. By focusing strictly on variance, they are ignoring how much total wealth was actually compounded over the 10 years. And they are exclusively measuring the rhythm of the waves.
Yes. They are asking if the actual heavily managed fund is bobbing up and down in the exact same rhythm as the hypothetical autopilot.
And what did they find?
When they ran the numbers across all 91 pension funds, the answer they delivered to the financial establishment was 93.6%.
93.6% of the variance.
Across the entire data set, 93.6% of the variance of each fund's quarterly returns over time was explained strictly by the movement of its underlying policy portfolio.
I mean, if the baseline policy dictates nearly 94% of the quarter-to-quarter movement, the immediate implication is devastating. We've established that these were massive, actively managed, highly compensated institutional funds.
Highly compensated.
What exactly were the stock pickers and the market timers contributing to the equation if their profound intellectual efforts only accounted for the remaining 6% of the movement?
They were contributing microscopic adjustments to an overwhelming tide. The researchers meticulously broke down the remaining variance. Security selection, the brilliant, deeply researched individual stock picks, accounted for an average of just 4.6% of the variance.
4.6%. That's essentially nothing. And market timing?
Market timing, the dramatic, sweat-inducing decisions to liquidate into cash or aggressively buy back into equities, accounted for a dismal 1.8%.
So the active decisions that consumed almost all of the intellectual energy, dominated the media coverage, and justified the vast majority of the management fees, explained a fraction of why the portfolio actually moved from quarter to quarter?
Barely a fraction. And to prove this was not merely a 1970s anomaly, they repeated the exact same study in 1991, utilizing a later data set covering 1977 to 1987.
Did the numbers shift in the new decade?
Barely. They found that policy allocation explained 91.5% of the variance. The numbers were incredibly, stubbornly stable. The ghost ship dictated the rhythm of the journey.
This empirically confirms that all of those equity analysts, portfolio managers, and macroeconomic forecasters were effectively expensive noise riding on top of a mechanical index?
Statistically speaking, yes.
But how does a deeply academic measurement of quarterly variance, the bobbing of a boat, transition into a sales pitch for wealth creation?
It transitioned through the most massive, fundamentally flawed game of telephone in financial history. The industry read the paper and immediately began shouting from the rooftops, "Asset allocation determines 93% of your returns."
But you just said the paper didn't measure returns. It measured variance.
Exactly. Brinson, Hood, and Beebower never actually wrote that. The financial industry completely conflated variance over time with total return.
That is a staggering logical leap.
They took a mathematical measurement of volatility, a measurement of the journey's bumpiness, and aggressively marketed it as a measurement of total wealth creation at the final destination.
The jump from volatility to total return requires a visual mechanism. If I am an investor reviewing a manager's performance, how does measuring the bouncing of a boat get translated into a systemic lie about how much money the boat brings back to the harbor?
Let us step away from the ocean and visualize two completely separate lakes side by side in a vast wilderness.
Okay, 2 lakes.
Lake A represents the actual human-managed pension fund's quarterly returns over the 10 years. It has 40 distinct data points, rippling up and down with every stock pick, every market crash, and every timing decision.
And Lake B?
Right next to it is Lake B, representing the ghost ship, the passive policy portfolio's quarterly returns. It also has 40 ripples, dictated entirely by the mechanical tracking of the benchmark indexes.
So we are comparing the surface of Lake A to the surface of Lake B.
Yes, when we measure the variance, we are asking a synchronicity question. When a gust of wind causes Lake B to ripple up by 5%, does Lake A also ripple up by roughly 5%? When Lake B crashes down by 10%, does Lake A crash down by 10%?
And the 1986 study proved what about these lakes?
The study proved that they are almost perfectly synchronized. Their movements are intimately linked.
We must strictly define the mathematical relationship connecting those ripples before we address the wealth creation aspect. How is the synchronicity between Lake A and Lake B formally measured?
That relationship is defined by correlation. Imagine two professional ballet dancers performing complex choreography side by side on the stage. If one leaps, the other leaps. If one drops to the floor, the other drops to the floor.
Even if one dancer is slightly taller, their movements are synchronized.
Exactly. Even if one dancer is slightly taller, their movements are perfectly synchronized in time. Formally, correlation is a statistic that measures the degree to which two variables move in relation to each other. The returns of the actual fund and the policy portfolio were highly correlated. Their variance was inextricably linked.
The analogy of the dancers and the synchronized lakes is mechanically clear. But frankly, it contains a massive, fatal blind spot regarding actual compounding wealth.
What is the blind spot?
What if Lake A, the actively managed fund, is rippling up and down perfectly in sync with the wind, but it is located at the top of a massive mountain, generating a 12% average annualized return? And what if Lake B, the passive ghost ship, is rippling in the exact same synchronized rhythm, but it is located deep down in a valley, generating only an 8% average return?
The altitude gap.
Exactly. The correlation is 93.6%. The variance explained is 93.6%. The dancers are executing the exact same routine, but the altitude is fundamentally different. If I am an investor, the synchronized rippling is irrelevant compared to the fact that the active manager dragged my lake up the mountain to a 12% return. Doesn't this mean the 93.6% figure tells us absolutely nothing about the actual wealth generated by the manager?
You have perfectly articulated the analytical breakthrough that took the quantitative finance industry roughly 14 years to formally admit.
14 years?
Yes, your critique of altitude is the exact critique formalized in the year 2000 by two legendary quantitative researchers, Roger Ibbotson and Paul Kaplan. They observed the absolute carnage of the Brinson misinterpretation and published a paper that essentially stopped the financial world in its tracks.
What did they argue?
They realized the industry was asking one question, but quoting the mathematical answer to an entirely different question. Ibbotson and Kaplan established a brilliant framework separating the issue into three completely different questions, which naturally yield three completely different answers.
Walk me through the three questions.
Question 1. How much of a single fund's wiggle, its ripples over time, is explained by its long-term allocation? This is the variance question. The answer, as Brinson proved, is roughly 9%.
Which confirms the synchronization of the lakes but ignores the mountain. If variance is merely the first question, what is the second analytical question?
Question 2 addresses the altitude gap between different funds. If you look at a massive universe of thousands of different funds, how much of the difference between the absolute winner who made a fortune and the absolute loser who went bankrupt comes purely from their differences in asset allocation?
So comparing the winners and losers directly, what's the number?
The answer to that is only about 40%.
Wait, 40%?
Yes, the other 60% of the difference between a great fund and a terrible fund is driven by active management, stock picking, exorbitant fees, and pure luck.
The implications there are severe. If my objective is to beat my neighbor's portfolio, my foundational asset allocation only explains 40% of my victory or defeat. That is a massive downgrade from the 93.6% dominance the industry claimed. What is the third question?
Question 3 is the absolute altitude. When looking at the total return level of a fund over a long period, the actual pile of compounding money generated,
How much of that absolute return is explained by the passive baseline policy?
And what did Ibbotson and Kaplan find for return levels?
The answer to that is essentially 100% on average.
100%? How is that mathematically possible if active management drives 60% of the difference between funds?
Because across the entire market, active bets are a zero-sum game. For every manager who brilliantly overweights technology stocks and generates massive wealth, another manager drastically underweights technology stocks and suffers severe losses.
So they cancel each other out.
Exactly. Across a broad aggregate, the active decisions cancel each other out entirely, leaving the underlying passive market return as the sole enduring driver of total wealth creation on average.
But if I am an investor paying an active manager, I am explicitly paying them to push my lake up the mountain. I am paying for high altitude. As an outsider evaluating this ecosystem, how do I mathematically judge if the manager's attempt to climb that mountain was actually worth the violent turbulence they inflicted on the portfolio?
It's the ultimate question.
Because if they dragged me up the mountain, but the boat was constantly capsizing because of their wild market timing, how do I evaluate that trade-off?
You evaluate it by demanding the Sharpe ratio.
The Sharpe ratio, let's define that.
Imagine you go to a massive amusement park and ride a terrifying roller coaster. At the end of the ride, you receive a highly detailed receipt that calculates exactly how much actual, genuine thrill you purchased for every single dollar of anxiety, nausea, and terror you had to endure.
A receipt for thrill versus nausea? I like that.
If the thrill was high and the nausea was low, it was an excellent purchase. Formally, the Sharpe ratio is the measure of risk-adjusted return, calculated by subtracting the risk-free rate from the return and dividing by the standard deviation.
So it measures efficiency.
Yes, it tells you definitively if the altitude the manager achieved was actually worth the violent bouncing of the boat. If a manager gets you to a 12% return, but takes on insane, uncompensated risk to achieve it, their Sharpe ratio will be abysmal, proving their alpha was an illusion.
Okay, so we've thoroughly established that the 93.6% figure was a measure of variance, an observation of rippling water, completely divorced from total return levels or peer-to-peer outperformance. Yet, this misunderstood number fundamentally rewired the global financial system.
It did. It completely rebuilt the industry.
I need to understand the structural mechanics of that real-world fallout. How did a deeply academic, fundamentally misquoted statistical observation about variance transition from a niche journal into the bedrock of modern capitalism?
It transitioned because it offered the ultimate mathematical weapon for a structural revolution that was already brewing beneath the surface. The real-world fallout of the 93.6% figure is staggering, and it begins with Jack Bogle, the founder of Vanguard.
Bogle was the pioneer of passive indexing.
He was. Bogle had been arguing since the 1970s that retail investors should abandon active managers and simply buy low-cost index funds. But he faced immense structural resistance from a Wall Street machine built entirely on high fees and the mystique of the star stock picker.
They weren't just going to hand over their fee structure without a fight.
Exactly. But when the Brinson paper was published, Bogle recognized its rhetorical power. He weaponized the 93.6% statistic, interpreting it for the masses to mean that active management was essentially a rounding error after accounting for exorbitant fees.
He weaponized the misunderstanding.
Yes. The marketing narrative became incredibly potent. If 94% of your outcome is just the mix of stocks and bonds, why are you paying a broker 2% a year to pick individual stocks?
And that worked?
Unbelievably well. That specific narrative, powered by the misunderstood statistic, validated the construction of index funds and helped balloon Vanguard's assets under management from $50 billion in the 1980s to over $8 trillion today.
Vanguard's ascendance relies on consumers actively choosing to purchase index funds, though. But the implications of this math go much deeper into the structural mechanics of how human beings are forced to save for retirement.
You're referring to default pathways.
Yes. If the industry believed asset allocation was the only variable that mattered, What happened to the default pathways of institutional capital?
The most profound structural impact was the birth and absolute dominance of target date retirement funds. By the mid-2000s, human behavioral economics conclusively demonstrated that 401k participants were paralyzed by choice, often leaving their retirement funds in cash or making disastrous timing decisions.
People freeze when given too many complex financial options.
Exactly. The financial industry, backed by regulatory shifts like the Pension Protection Act of 2006, required a single, foolproof default investment option for millions of workers. And the entire intellectual justification for defaulting trillions of dollars into target date funds was built squarely on the Brinson logic.
Asset allocation is 93% of the outcome.
Right. The industry argued that if asset allocation dictates 93% of the outcome, there is no need to ask an employee to pick stocks. The solution was simply to place them on a mathematically sensible glide path, heavy in equities at age 25, slowly and mechanically shifting toward fixed income as they approach age 65, and ignore all the variables.
And it worked. Today, target date funds are the undisputed leviathan of the retirement system, all built on the premise that the fundamental mix is all that matters.
That is the foundation.
But at Wall Street utilized this logic to build default pathways with human brokers and target date funds in the analog era. What happens when Silicon Valley algorithms capture the exact same flawed math today?
You mean the robo-advisors?
Exactly. The entire robo-advisor landscape, companies constructing algorithmic wealth management, appears to be the Brinson 1986 paper wrapped in mobile architecture. They do not sell stock picking.
No, they don't.
They ask you 5 questions about your risk tolerance on a screen, construct a passive portfolio based on the efficient frontier, and charge a minimal fee to automatically rebalance it. Furthermore, this single statistic entirely shifted how human financial advisors get paid, moving them away from the old model of earning a commission every time they hawked a hot stock to the fee-only fiduciary model where they simply manage the asset allocation.
The robo-advisors are the ultimate technological manifestation of the policy portfolio ghost ship. They mechanically maintain the exact coordinates of the blueprint, rebalancing without emotion or human intervention.
And the human advisors?
The massive shift to fee-only fiduciary registered investment advisors, RIAs, was justified by the exact same logic. If an advisor's primary value is no longer uncovering the next technological behemoth, but rather constructing a rigorous asset allocation and behaviorally coaching the client to stick to it during market crashes, then they should be compensated as an asset manager.
Taking a flat percentage of the total portfolio rather than a broker hustling trades.
Correct. But this brings us to the agonizing tension of the entire trade. The financial industry fundamentally revolutionized wealth management, democratized indexing, slashed fees, and protected millions of people from their own worst stock-picking impulses.
Which is a massive societal good.
It is. But they achieved this massive societal good by perpetually citing a statistic that did not mean what they told the public it meant.
This leads to a razor-sharp rhetorical question. Did the passive investing industry, the target date fund providers, and the fiduciary RIAs essentially sell the patient the absolute right medicine, but use fundamentally fraudulent lab results to convince them to swallow it?
I can see that the answer is yes. The underlying medicine, focus on your long-term mix, diversify globally, keep your fees microscopic, and ruthlessly ignore the manic noise of the daily stock market, was mathematically and behaviorally sound for retail investors.
It was the correct structural prescription.
It was, but the marketing brochures, the pie charts presented in million-dollar boardrooms, the ubiquitous claims that asset allocation determines 93% of your return were fundamentally misstating the data.
They were quoting the variance of the ripples on the lake to implicitly promise the altitude of the mountain.
Exactly. And eventually, the intellectual bill for that systemic deception came due.
So who actually blew the whistle on this? In an ecosystem that moves trillions of dollars based on consensus, standing up and declaring that the foundational statistic of the entire industry is a misdirection requires intense forensic courage. Who looked at the emperor and pointed out that he was wearing no clothes?
The most explosive reckoning arrived in 1997 when a fiercely independent financial planner named William Janke published a devastating critique in the Journal of Financial Planning. He titled it, quite bluntly, The Asset Allocation Hoax.
The Asset Allocation Hoax. That is aggressive.
He aggressively called out the intellectual fraud of financial advisors utilizing Brinson's variance pie charts to implicitly promise total return outcomes to their clients. Janke pointed out a catastrophic flaw in the logic.
Which was?
If you tell a client their asset allocation is responsible for 93% of their wealth creation, you are lulling them into a profound, false sense of security. You are implying that as long as the 60-40 mix is correct, the actual returns will inevitably materialize.
Which ignores market valuations.
Completely. This completely ignores the reality that a 60-40 mix purchased at the height of a massive macroeconomic bubble will result in absolute wealth destruction, regardless of how perfectly the variance correlates to the underlying benchmark. Janke forced the industry to look in the mirror and acknowledge that fixed asset allocation does not protect against profound market overvaluation.
Janke opened the door. But to fully understand this, we must tear the house down to the studs. I want to know what else Brinson, Hood, and Beebower missed entirely. An academic paper from 1986 cannot possibly encompass the violent complexities of modern algorithmic retail-driven markets. What are the severe structural limitations of this foundational text?
The limitations are profound, and we must dissect three critical failures. First, and perhaps most crucially, pensions are not people.
What do you mean by that?
The 91 funds in the Brinson dataset were massive, hyper-disciplined institutional behemoths. They rebalanced their portfolios mechanically, without emotion. They operated on generational timelines.
Right. They did not wake up in a cold sweat, read a terrifying macroeconomic headline on a Tuesday morning, and liquidate their entire equity position into cash.
Exactly. Does a 90% variance correlation hold true for a highly emotional retail investor or a day trader swinging wildly between asset classes? Absolutely not. Human panic entirely destroys the correlation. The ghost ship sails straight, but the human boat capsizes.
That's the first limitation. What's the second?
Second, we must address the 1970s and 1980s anomaly. As we explored, the dataset covered a highly specific, highly volatile macroeconomic environment. Applying the exact variance decomposition of that unique historical epoch to the zero interest rate environment of the 2010s or the algorithmic flash crash dynamics of the 2020s is intellectually perilous.
The environment changed, so the decomposition might not hold. And the third limitation must address the practical reality of how capital is actually moved.
How so?
The paper appears to assume a pristine, laboratory-grade separation between the policy portfolio and the active manager's decisions. But in the real world of trading, that rigid separation is a complete fallacy. A fund-stated long-term policy inherently drifts as asset prices change.
The drift is inevitable, yes.
If a specific sector of equities doubles in value over a year, the policy weights and the active weights bleed into one another. The manager is constantly negotiating between the rigid mandate and the fluid market reality. The actual execution is never as mathematically clean as the decomposition suggests.
Your identification of the separation fallacy perfectly mirrors the most advanced quantitative research of the modern era. The evolution of this debate from 2010 to 2025 has essentially deconstructed the Brinson premise at a molecular level.
Who led that research?
In 2010, a seminal paper by researchers Xiong, Ibbotson, Idzorik, and Chen pushed the analytics to their absolute mathematical limit. They proved that a massive portion of what Brinson originally attributed to the genius or the structure of the asset allocation policy was actually just the raw underlying momentum of the broader market moving everything simultaneously.
Moving everything at once.
Yes. To fully comprehend the 2024 and 2025 multi-asset research that followed, we have to formally define our final vital concept. We must understand beta.
Define beta mechanically, because active managers constantly deploy that word as an intellectual shield to excuse their own underperformance.
Imagine a massive harbor filled with hundreds of boats. Some boats are captained by absolute geniuses, perfectly trimmed, gleaming and hydrodynamically efficient. Other boats are barely held together, captained by complete fools.
Okay.
But when the moon's gravity pulls the ocean tide in, the water level in the entire harbor rises by 10 feet. Every single boat, regardless of the captain's skill or the boat's condition, goes up 10 feet. Beta is the rising tide.
So it's the baseline movement.
Formally, beta is a measure of the volatility or systematic risk of a security or a portfolio in comparison to the market as a whole. Modern factor-based research over the last few years has conclusively demonstrated that term structure, the varying yields of bonds over different time horizons, and market beta factors explain almost all compensated risk in multi-asset portfolios.
Which implies what for the active manager?
When you strip away the illusions and decompose the returns with modern computing power, tactical allocation skill is vanishingly rare. The market's macro movements, the raw beta, dictate the reality of the portfolio.
Let us pull these threads together. We started with a multi-billion-dollar institutional puzzle, a massive 10-year data set, and a profoundly misunderstood statistic regarding the variance of rippling lakes.
We did.
I have demanded precise definitions for the mechanics and have challenged the conflation of variance with total compounding wealth. But looking at the entirety of the evidence, the Ibbotson-Kaplan clarifications regarding altitude, the reality of market beta acting as the rising tide, the devastating impact of fees on the Sharpe ratio, and the absolute zero-sum nature of active trading, I must acknowledge a fundamental truth.
Which is?
Despite the horrific, decades-long misquotation of the 93.6% figure, the underlying philosophy holds immense weight. For retail wealth, focusing ruthlessly on the foundational asset mix remains the single most powerful lever an investor possesses.
It really does.
The manic security selection, the adrenaline-fueled market timing, the desperate search for the perfect alpha. They truly do net out to a rounding error in the grand calculus of long-term compounding.
I completely agree, and that realization brings us to the ultimate paradox of this entire history. The truest, most enduring ideas in finance often manage to survive the absolute worst, most mathematically sloppy marketing campaigns.
It survived because the baseline advice was right, even if the math was misapplied.
Precisely. The Brinson paper did not measure what the industry claimed it measured. It measured the synchronization of volatility, not the generation of absolute wealth. Yet the behavioral framework it accidentally birthed, diversify broadly, keep costs microscopic, ignore the terrifying noise of the technical storms, and trust the mathematical power of the long-term baseline, saved an entire generation of investors from themselves.
It's a fascinating conclusion.
The takeaway is imperative. The next time a financial professional sits across from you, slides a glossy brochure across the table, and points to a massive pie chart claiming that one specific lever guarantees your financial future, you must relentlessly question the underlying data.
You have to know what's driving the numbers.
Demand to know if they are measuring the ripples on the lake or the absolute altitude of the mountain. Demand to know the Sharpe ratio of the ride. The truest power in finance belongs to the investor who understands exactly what the math is measuring, and more importantly, what it is hiding. This is the Research Desk officially signing off.